Welcome to our third Thursday at 3. I'm Brady Serold, Senior Vice President of Disability Income Services with E4. A few housekeeping items. Please answer the anonymous poll question for me to gauge your exposure to selling DI. Just kind of a fun thing that we're starting here. This webinar is also set up so that everyone can interact with each other using their camera and audio. Everyone can start by staying on mute. It is up to you whether you have your camera on. If you want to ask a question, please use the hand raise or reaction button on top of the toolbar, come off mute, or put your question in the chat box. Today's third Thursday at 3 will be recorded and posted to our Marketing Central in our advisor portal and on our E4U page. YouTube page. Everything in your client's financial plan hinges on their ability to fund it to completion. Regardless of occupation, everyone working client needs a plan if they get sick or hurt and can't work. Excellent. Well, see, very few, never. Great start. So hopefully you're on the right webinar if you want to learn how to sell some disability or at least talk about it. Well, here we go into our start our presentation for our first third Thursday of 2026. All right, again, welcome everyone. Again, go over our quick agenda. Today we're going to talk a little bit about why advisors don't talk about disability income. Focusing on the plan, not the features. Let's keep it simple. Kind of a what's your plan, how you're going to pay for your plan. Client life stages. Where does disability fit at each stage of a client's life? A little case study and solution. Then how E4 can help. Why advisors don't talk about DI. I've been doing this about 32 years now, and you have a lot of reasons, but I think the number one reason is a lot of advisors don't understand it and are not proficient in it. Therefore, people don't proactively mention topics that they're not fluent in. Again, most of the time it's for fear of saying the wrong thing or the incorrect thing. But again, most advisors just are adverse to things they're not familiar with. Secondly, they've had a bad experience. And disability underwriting can be very, very difficult. I'm not going to talk about disability underwriting today, but those are some things that we can help you with at E4, as I've had a few years of underwriting experience in my beginning of this career. So again, underwriting can be different. And again, the one thing your client doesn't want to get in the mail is a letter that says they've been declined, because when they get that letter, they tend to be pretty angry. And then the other part, I think, which is a total myth, is clients believe they're covered at work. And when advisors check off, they say, hey, are you covered for disability? I say, yeah, I got something at work. And they just check off the box. So they just kind of leave it at that. So I think those are probably the three main reasons why advisors don't talk about disability in a proactive manner. You've got to remember, insurance is not your plan. Change your verbiage. Again, I don't think any client ever thinks they're going to become disabled, but if you ask them sick or hurt and can't work, it's a totally different thing. I believe most people think at some point during their working career, they could become sick or hurt and not able to work. Now, that might be for a day, it might be for a week, it might be for a month, or they might never come back to work. Again, they just don't know what that timeline might be, but sick or hurt and can't work, replace the word disability. And again, and what's your client's plan? It really involves about asking that simple question. What's your plan if you get sick or hurt and can't work? And just stop talking. Most people don't know. Again, however, that's what I say, this insurance, it can help fund the plan, but it's never your plan. Again, focus on the plan, not the features. Keep it simple. Let's have a little bit of talk about the what's your plan conversation. And I don't care if somebody makes $50,000 a year or $500,000 a year, they still need a plan. But every person that I've found has these same basic needs. And I'll say it's 5+. The first one is everyone has to have a place to live, and for most people, that costs something. Secondly, you got to eat, and so there's a budget for that. Utilities, and that's phone, gas, electric, water, internet, whatever it might be. So you got to pay your utilities. You have to have transportation. So again, that would be, your car to get to and from, appointments. Your family still needs to have a car, and insurance. So those are the 5 basic things that everyone has to have if they get sick or hurt and can't work. And remember, those are their numbers. They're not your numbers. So obtain those five numbers from your clients. And then we have the other thing called lifestyle. And again, the more money you make, the bigger your lifestyle is. And when people obtain a lifestyle, they don't like to get set back. So understanding what those 5 basic things are, and then how much of their lifestyle they want to have covered, that gives you a number of exactly what they need if they get sick or hurt and can't work. So then you kind of move to how are we going to pay for this plan? That's kind of the next piece is, I know what my need is, but how am I going to pay for it? Savings. Okay, well, we're not really in a savings society. And I'll talk a little bit later about from an age bracket, but if you're in your 20s or maybe early 30s, you surely don't have a lot of savings if you're saving at all. And then investments, again, as you get later in your career, investments can become a bigger part of your portfolio, but they're small in the beginning and take time to grow. 401k, most commonplace people are putting money, especially if an employer matches those funds. But what's the purpose of that 401k? It's for retirement. You don't want to pull upon it in the event of a disability. There's potential taxation issues and penalties. Again, there's different rules and regulations there. I'm not a 401k expert, but again, probably not the best place to take money from. And then you can sell items. Oh, that's a good place. Most people, when they need to sell something, they want to sell it. It's not when somebody else wants to buy it. So again, you're at the mercy of what somebody wants to pay for it versus what you paid for it or what the item is really worth. And then change your lifestyle. Again, I don't think people want to change their lifestyle. They've grown accustomed, their family's grown accustomed to it. So changing lifestyle, well, you can make some minor adjustments to save some additional cash flow. But again, some of those items might be replaced by additional medical costs that somebody might have. So again, a lot of times, even if you change lifestyle, there's a replacement of something else that comes into play there. The government, Social Security, disability. I think the government is probably the last place we want to rely on. If we get sick or hurt and can't work, it is there. I think at last look, the average monthly benefit was about $2,200. And remember that benefit is taxable. So, it really isn't a true benefit there.
A review of our top 10 equity holdings as of December 31.
I'm gonna have somebody, they could mute, please. Thank you. And then employer disability coverage. Do you understand how it works? And when you look from a group long-term disability standpoint, I think the last stat was about 35% of all employers have any sort of employer-paid long-term disability coverage. So if your employer does have something, hey, that's great, but I think you need to understand how it works, and that's something we can help you with here at E4. You just obtain their summary plan document and understand that there's a lot of moving parts to group long-term disability, and the last place you want to know, or last time you want to know, is when you need it bad. So again, let's figure out exactly how your employer plan works and explain that to you. And then you have your personal income protection, so that true individual disability coverage that you can customize and design based on need and budget. And you'll find that other than our case solution, which I'll briefly talk on products and features, I'm not going to talk really about any sort of feature within a contract. That's really catered to an individual. And once we know a need and a budget and kind of what they do for a living, we can design the right plans based on that need and budget. So again, you kind of take a look at most individuals. Yeah, I'm never going to become disabled, right? Again, replace it with sick or hurt and can't work. People have that it won't happen to me mentality. And I think the younger you are, the more invincible you feel you are. But again, I think when you're younger, you have a lot more to lose. But you kind of take a look at this. 1 in 120, 1 in 225 are going to get an IRS audit. 1 in 5 are going to be involved in a serious car accident. But the odds of becoming disabled for a 20-year-old is 1 in 4 between now and age 67. Again, the odds are there. Perspectives on disability. People have a kind of a jaded sense of what disability looks like. And, I think most people believe, for those who are older on the call, we had Christopher Reeve, fell off a horse, broke his neck. He lived for 10 years. And he did have a Lloyd's of London policy that insured, but it probably didn't pay the cost of what his care handled there. So again, most things aren't accident related. Most things are illness related. So again, that, you can kind of look in the statistics here, 12% are injury. Everything else in that realm are illness related. And again, people tend to recover from accidents. Illnesses, they can stabilize and tend not to recover from fully back to what you were before. And then you kind of go feeling the impact. And this is from a 2020 LIMRA study, but I'm sure it rings true today, probably even more so, and especially after COVID. But, looking at the financial hardships that a family would occur if they lost their wage earner, 61% don't know what they would do after 6 months. Again, I think there's a lot of serious planning discussions that are potentially available. Again, a person might not qualify for disability insurance, but if they don't qualify or their occupation doesn't qualify, they still need a plan. So it's our job as advisors to help them and decipher what plan that might be. Again, clients have no problems insuring their stuff. You look at these things here, you got snowmobiles, quads, boats, phones, homes. Again, you kind of look at these items that people have. And this morning I was like, I shouldn't just leave it at that. I wanted to provide a little bit more anecdote in here, but the average car insurance, and I took North Dakota because that's where we're headquartered, for a $40,000 automobile is $2,200 a year. So a $40,000 car costs $2,200 a year to insure. That's 5.5% of the cost of that car. Next year, is that car worth $40,000? Nope, it's worth less. So they're going to charge you less for your insurance, right? Nope. So every year you have your car, potentially your insurance is a higher percentage of the cost value of that asset. So again, you took a snowmobile, kind of funny, an average snowmobile, $10,000, $450 a year to provide full coverage for that snowmobile. 4.5% of that depreciating asset. The crazier one is the iPhone. It's about $1,200 for a new iPhone 17 Pro, $140 a year to insure it. That's 11% of the cost of a depreciating asset that in probably 2 years, you could go get a brand new one. But people are buying this stuff. It's crazy. So what's your client's biggest asset? Have you ever asked them that? It's actually their ability to go to work and earn an income. They are their most valuable asset. You look at a client and ask them, if you had an ATM in your basement that printed $50,000 a year, would you insure it? I can't think you'd find one person who wouldn't insure that asset. So let's take a look at a earnings potential. A 25-year-old planning to work the next 40 years, that'd be nice. At the starting income at $50,000, you're looking at $2 million in base earnings potential at a minimum. That person's probably going to get raises. Again, so from what they do. So that's just a minimum for a 25-year-old. And the average cost to insure that $50,000 appreciating asset is 1 to 3% of their annual income. So we looked at those other things that I discussed earlier. Your car, 5.5% of the cost of that asset. A snowmobile, 4.5%. An iPhone, 11%. But people aren't protecting their incomes adequately. Again, it's for a relatively inexpensive cost. They can ensure that appreciating asset is covered until they could typically age 65 or age 67, which is their normal Social Security retirement age. Again, they are that ATM. So again, putting them in a little different perspective in, what their most valuable asset is. Kind of go look at the stages, the early career, your 20s and your early 30s, really the foundation. That 20 to 35, $50,000 is kind of like the starting place from an income where you'd want to look at a client. Now, if they're self-employed, that's a little bit different because they don't have any employer paid coverage. So again, you to write off a lot of things. So there's potential for, personal coverage, overhead expense to help, some of those fixed expenses of the business that would incur regardless if they're working or not working. Again, just a different discussion. And the early people, they're relatively healthy. Very few exclusions potentially on a policy. These individuals are highly reliant on their income for all their expenses and their lifestyle. GoFundMe only lasts so long, and most people don't want to return to their parents' couch. However, I had my daughter living here while going to grad school, and I guess I provided too fancy of a lifestyle for her. But eventually, she moved out on her own. Again, the coverage is inexpensive. So, from the standpoint of looking at it, again, $50,000 a year income, you're looking anywhere between, $500 and $1,000, at the most, probably $500 to $750 of potential annual premium for covering about 60% of their income. Again, and the other part with when you're young, they put on guarantee insurability options. So, similar to term insurance, when you're talking about the importance of conversion for later in life when you don't know what your health is going to look like, disability has the same thing. So as your income grows, if you bought somebody a starter disability policy, because that's what they qualified for today at $50,000 and maybe it was $500 a month, they've locked in their insurability. And there are some carriers that you can move all the way to $30,000 a month without having to provide another piece of medical evidence, only financial. That's incredible. The potential risk that you're able to cover, and then as it grows. And then from an advisor standpoint, every time they get a raise, you can review their disability coverage. Each little piece you get paid first year commission on, as well as renewals. And remember, for most carriers, disability renewals are fully vested and they go from years 2 to 10. So it's one of the better paying products as well. So if you get them when they're early, underwriting's good, they go through, the premiums aren't high, but it's not about today. First is doing the right thing and making sure their, most valuable asset is covered. But secondly, you provided their, security from the standpoint of anytime they have a lifestyle or an income increase, they can potentially bump up their benefit with only providing, tax documents. So we kind of move into that mid-career, your mid-30s, maybe up to 50. You're in your growth mode. You have responsibilities now. I know sometimes those responsibilities aren't fun, but other people are relying on you. If you're married, have a partner, have children, own a home, as you get older, you might have parents who are reliant upon you. Your income is growing, but you're not at the top income level yet. You're starting to see some growth because you're finally being able to save some money and put it away, whether it's in savings and or investments. But again, a small period of disability could wipe that out quickly. And it might have taken you 10 years to grow that nest egg, and maybe 6 months, 12 months, 24 months, that nest egg that was meant for retirement is completely gone. And again, if you're 20 and become disabled and go back to work 4 or 5 years later, you can probably recover. But if you're 40 years old and go out of work for 5 years, it's catastrophic to your total savings plan. Again, somebody had told me once, your retirement plan is only predicated on funding it to 100% completion. And the quickest thing to do that is ending that is not being able to work anymore. So again, in your 30s and 40s, your health, you're still in pretty good shape. You might have a few nicks and, dents as some of us do. You're not as good as you once were, but as good once as you'll ever be. Again, you might have, you see a chiropractor for some back issues, you might have an exclusion rider on your back. Okay, probably not what's going to disable you long term. But again, those are the things that when we do some pre-screening up front that we can give you and set those expectations correctly, going forward, so that when we do get an offer from the carrier, first, we're choosing the right carrier to go to, but secondly, it kind of looks like what you are going to have proposed. And then there's career opportunities. Most people don't work for the same company their entire career. I mean, my dad was a lifetime employee for 3M Corporation out of Minnesota, and he worked for them for 36 years. I mean, I've been now 32 years, and I've been with 6 companies. And I think it's even becoming more where individuals are, you know, more floating from one company to another company. So again, those career opportunities, the portable benefits, that's kind of what we're creating here. This is a disability policy that if you left your current employer and maybe you had the opportunity to go to work for yourself and you're not insurable, well, you might think secondhand of doing that, because if you don't have proper insurance, you might not be able to take that risk. So again, putting this in, and maybe you had a starter policy and you lost your group plan. Well, guess what? You've now had a change in financial situation, and you could bump your benefit up to whatever you qualify for based on the income you're earning at that time. So again, having a personal policy allows that flexibility from a career standpoint. And then you got your late career. Let's don't forget about these individuals, because these people need to know what their plan is if they get sick or hurt and can't work, if they don't already. I mean, you're on the retirement red zone. You're at the highest income earning of your life. You're just starting to really think about and plan for your retirement. Your assets might be there to self-pay, but you can't retire yet. Again, your odds of disability are the highest. Premiums might be more expensive, but again, you might not need all the bells and whistles that a 25 or a 30-year-old would want in their policy. Again, it's having some sort of plan. Again, there might be some health history that might prevent you from getting it. But again, we have options outside of the traditional carriers, like with Lloyd's of London, for graded benefits. But again, don't forget these individuals, because these are the ones that if they could retire today, they probably would, but they can't. So today is when they need their income the most. And a quick drain 2 or 3 years out of their retirement savings would drastically change their retirement plans. So understanding, where they're at in a different phases of life, again, structuring plans, and I say need and budget, we can design a plan for you. And then the other part, you kind of look at what happens when you do retire. An agent asked me that, hey, what do I do? I said, stop paying the premium. Well, do they get anything? I'm like, well, did you get them a congratulations on retiring card? Kind of make it as a joke, but hey, nobody wants to ever use this insurance, just like your car insurance. But when an advisor used to tell me this, when you need it bad, you want it good. And if they've already purchased a disability plan, and they're stopping working, well, guess what is the next thing? Is long-term care. Again, you could potentially then use the funds that they're already have allocated towards that and move that towards, some sort of long-term care product. So do a quick case study. The music from the beginning, from The Office, kind of goes in with our case study. But meet Dwight Schrute, this 35-year-old sales executive, regional manager with the old Dunder Mifflin, $150,000 of income, $50,000 salary, $100,000 in commissions. He has a long relationship with his insurance advisor, Michael Scott. At a recent celebration, Michael asked Dwight, hey, what's your plan if you too sick or hurt to work? Of course, Dwight, in typical Dwight fashion, kind of freaked out and said, never been sick, perfect immune system. Plus, I run the benefit division here, and I'm certain that 60% of our income is covered. So Michael dug a little bit deeper. Just didn't take Dwight at his word for it, and kind of dug a little deeper into the group LTD plan there at Dunder Mifflin. And here's what he found. Fact, he does have 60%, but it covers the base salary. It doesn't cover his total compensation. This is pretty common with most group plans. About 90% of all group plans only cover base compensation. And a lot of our clients have not only commissions, but they probably have some sort of bonus or incentive compensation. Another thing, it's capped at $5,000 a month. So while Dwight was correct at the 60% level, even if it did cover his commissions, it would only cover up to $100,000 of earnings, not his $150,000. So when he took a look at it, Dwight actually would only have received $2,500 a month in benefit, when Dwight thought he was going to get 60% of 150,000, which would be $7,500 a month in benefit. Oh yeah, and the other part is the employer pays for it. So it's taxable. Now this
I got a webinar.
this $2,500 only represents 20% of his income, but it's taxable. So his net benefit's actually about $1,750 a month. So when Dwight thought he had $7,500, and then he comes to know that he only has $1,750, and I'm pretty sure at $150,000 a year between his mortgage and utilities and probably his food, the $1,750 is gone. So then what does he do? So kind of the solution. So Michael worked with his team here at E4 to help develop. $6,700 a month is what he was able to get of additional individual disability income with a 90-day elimination period, an age 67 benefit period, a 3% cost of living, which is when you go out on claim, your benefit goes up 3% compounded each year. A catastrophic rider, which is kind of the umbrella policy for your income. If your disability is the result of 2 of the 6 activities of daily living and or a severe cognitive impairment, you get up to an additional $4,500 a month, which between the group, the individual, and the catastrophic rider is 100% of his income. And then there's a residual rider in there. So if he could do some, maybe as a part-time, could come back to work, so allowed him to recover and come back to work, there's some payment in there. And it costs $312 a month for that policy. So in the end, he would be getting $8,500 a month tax-free, so 68% of his gross income. And that $8,500 comes from $2,500 less the taxes, plus the tax-free individual benefit, so $8,500. Now, again, he would get that additional $4,500 on top of that, and that would go to age 67 if that was the result of 2 of the 6 activities of daily living or a severe cognitive impairment. And that $312 represents 2.5% of his annual income. Again, we look at those other things, they don't have a choice. They're paying 5.5% for their car. I mean, 11% for their iPhone if that's what they're doing. So again, it's in perspective to in relationship to other things that they insure, it's a relatively inexpensive thing to insure for an asset that, in this case, $150,000 a year at age 35, 30 years to work. I mean, you're at $4.5 million right there without any increases. So why E4? Again, we have our support team. Myself, I've 10 years as an underwriter, been involved in the sales side, product development, again, anything you could do in the disability world. That's what I've done over the last 30 years. You have your regional VP and case manager who you work in with normally. So I encourage you to bring them into conversations. We have our case support specialist, and she works on our guarantee issue business, which I think will probably be one of our topics later this year. And then our marketing team, Sydney and Jesse have put together some great pieces in there on our sales tracks. So you can kind of look in our Marketing Central and find those sales tracks. They'll have LinkedIn posts that you can take and use in your name, phone and email scripts to use to reach out to clients. And again, there's no reason we shouldn't be able to just say, hey, there's something I haven't done. It's about your plan if you get sick or hurt and can't work. I just need to be confident that something happened to you tomorrow, that your financial plan and your family would be okay. So we can use Choose Your Journey. Again, we're here to provide step-by-step directions. We can serve as your guide, or in some cases, we work with advisors and run the case because they're not comfortable with it. So, we can do any of those 3 things with you. And then the carrier lineup. Again, we have all the access to all the carriers with the exception of Northwestern Mutual and New York Life because they're captive. So again, the white collar space, it's really Ameritas, Mass Mutual, Principal, and the Standard. We have the guarantee issue market as well. We do have availability of worksite disability. So in addition to guarantee issue, there's the straight worksite, which is similar to an Aflac or Colonial. We have the blue collar carriers. Again, because you swing a hammer for a living or dig a ditch, that doesn't mean you don't need disability coverage. We have products that are suited for those occupations. And then the specialty excess and impaired risk. So really the Lloyd's of London type carriers where, maybe it's an impairment like an insulin dependent diabetic who a traditional carrier wouldn't cover. Maybe it's coverage above and beyond the $30,000 a month limit that traditional carriers will coordinate with. I mean, Lloyd's will do up to $120,000 a month total coverage at 65% replacement. Maybe it's athletes. I mean, we've been quoting a couple college players that are potentially going to go to the NBA. We've written a couple of hockey players that are, in the minor leagues that are trying to get up to the show to play. So again, there's a lot of different risks that we can look at and insure. So, again, that's kind of it here. I don't know if anybody does have any questions, the chat. Not seeing anything here. But, again, I appreciate everybody coming and joining us today. Hopefully it was helpful. Again, we're here to help you in any way we can. Next month, our third Thursday at 3 will be held on February 19th with Doug Twitty, our Director of Annuities, and he'll lead a session on how to properly structure a tax-free retirement. So stay tuned for that registration link. Again, thank you all for joining us today. And if you have any questions or want to learn more, contact your RVP or myself. Thanks again and have a great day.